Hey everybody, I'm Asa Goldberg-Berman. Today I'm breaking down Western Digital's acquisition of SanDisk, a $19 billion deal that was supposed to create the world's dominant storage company. It's a great case study because the strategy made total sense on paper, but completely fell apart in practice. Western Digital makes hard drives, the traditional storage inside laptops and servers. SanDisk makes flash memory. Think about SD cards, USB drives. It's the faster storage that was starting to replace hard drives everywhere. In 2015, Western Digital bought SanDisk for $19 billion, paying roughly a 33% premium over the market price, funded mostly by taking on $17 billion in new debt. The logic was straightforward. Hard drives were a shrinking market. Flash storage was the future. Rather than slowly get replaced, Western Digital decided to buy the best flash company in the world and own both technologies under one roof. They also projected a $500 million in annual cost savings from combining the two companies, and expected SanDisk's stronger profit margins to lift the whole business immediately. They paid about 3.3 times SanDisk's annual revenue, reasonable for a high-growth business. The real risk was the $17 billion in debt they took on to do it. In a cyclical industry where revenues swing dramatically year to year, that kind of leverage leaves almost no room for error. The market was skeptical from day one. SanDisk stakeholders were happy. Their stock jumped 15 to 20% on the announcement. Western Digital's stock, though, never recovered. Over the following 7 years, Western Digital dropped 30% while the S&P 500 gained over 100%. Most tellingly, Seagate, their main competitor, which stayed focused purely on hard drives, outperformed Western Digital by 229% over the same period. The market was sending a clear signal the entire time. And the market was right. The promised savings never materialized. Both businesses underperformed. By 2023, hedge fund Elliott Management, run by billionaire activist investor Paul Singer, sent a public letter to the board stating the deal had destroyed $13 billion in stakeholder value and demanding a full breakup. In February 2025, that's exactly what happened. SanDisk was spun off and relisted as its own independent company. 9 years and $19 billion later, they ended up exactly where they started. There's 3 lessons we can take from this. First, good strategy doesn't guarantee good execution. Combining two completely different business models is much harder than it looks on a slide. Second, debt can be a trap. $17 billion in borrowing eliminated any flexibility when things went wrong. And third, listen to the market. Western Digital's stock reflected investors' skepticism from day one. That signal was there the whole time. Thank you for listening.